You could say we have now broken out, as he said, above a 12-year cup and handle formation, an incredibly bullish formation. Nonetheless, I think a lot of it has to do with what we've seen in the Shanghai Metals Exchange over the past 2 months. And when you take the Shanghai Metals Exchange, which are contracts for immediate delivery of physical gold, along with the Shanghai Futures Exchange, their combined average daily volume over the past 2 months has increased more than 200%, which effectively makes the Shanghai Exchange, or the combined markets of the Metals Exchange and the Futures Exchange, the second largest gold trading market in the world, only second to the London Bullion Metals Association.
In today's market recap, CME Group Micro Gold, Silver, and Copper Products update. Gold prices hit an all-time high of $2,448 on April 12th, 2024, on the back of hotter than expected NFP, sticky inflation, and rising geopolitical risk. These factors attracted inflow of funds, as shown by increasing managed money long positions to around 2-year high. Despite the pullback towards the end of the month as profit-taking and U.S. dollar strength took effect, gold prices managed to settle at $23.02, up 2.9%, heading into the next Fed's meeting and non-farm payrolls in May. Riding on the price momentum of its yellow counterpart, silver prices also reached its 3-year high of almost $30 on April 12, 2024, but the consolidation in the second half of the month brought the price back to $26.65, up 7%. With that said, the managed money long positions remained elevated. Key Chinese smelters' decision to cut output by 10% this year due to plunging refining fees and shutdown of Cobre Mine in Panama have raised supply concerns, and inflow of funds buying pushed the managed money long positions to 3-year high. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hit the like button, and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
This is something that I think is worth contemplating. Are the Chinese really turning up the heat? There's been a lot of articles lately talking about the May contract and the deliveries and the shorting. And it's interesting. What I have taken away from it is that HSBC Bank, either for their house account or by proxy for one of their clients' accounts, has been shorting the price of gold, but we've seen tremendous amounts of exchange for physical move to China, and there is a Brinks facility in Hong Kong that is part of the COMEX ecosystem. And a week ago Friday, we saw 243,000 ounces, over $571 million worth of gold, that was delivered in that direction. And anything that ends up going to Hong Kong, just about all of it to Hong Kong Brinks, is exchanged for physical. And we're seeing the price be knocked down on the Western exchanges, and then contracts bought in the OTC market for exchange for physical for delivery in Hong Kong. And the theory is that there are trucks picking that up and bringing it right over to the Shanghai Exchange, which is aiding in the delivery of metals, like we're seeing here, up 200% in the past couple of months. When we started talking about these things way back when, Dunnigan, in 2020, we talked about the rise of the others, these people that were bleeding dry the markets. But you can only do that so long before you start to get on the radar screen, so to speak. And they're finding more and more and more clever ways, in essence, to drain the Western system by suppressing the paper price and standing for delivery. Or in the case of the Shanghai Metals Exchange right now, pricing silver at $3 higher to slowly turn up the arbitrage heat. So none of this surprises me at all. It just, to me, seems that it's an acceleration by the countries who understand what's going on, and China leading the way with that. And I'm sure that's certainly painting the tape to Bill's point, to make it look like we're right at the cusp of some serious action in the gold market. It appears that way, at least by what's going on in Shanghai. Senegal, Cameroon, Algeria, all of these countries are repatriating their gold over the last 60 days as well from the New York Federal Reserve. And it's Senator Mooney, I believe, out of West Virginia, who not only has floated a bill to have the federal capital gains tax taken off of metals purchases, but or sales rather. But also, he asked, through the Freedom of Information Act, how many countries are repatriating their gold, and he was stonewalled. Information is coming out right now, but to me, this all boils down to a broken glass. How do you put back together a broken glass? Well, how do you put back together the broken trust? And I think when you see massive accumulation of gold, when you see massive repatriation of gold at the highest level, it to me is a bigger issue of trust than just about anything else, or in this case, the lack of trust that I think is what we are witnessing, and the move away from accepting U.S. Treasuries as a place to park your money. And so I really do believe that oil and gold are being remonetized around the globe. They are being used as money and as settlement in place of U.S. Treasuries. And so the settling of all of these trades around the globe in local currencies, and then the excess reserves being parked in gold and oil instead of U.S. Treasuries, is what we are seeing. And this is why I think this leads to a situation where maybe hyperstagflation, where no one's going to want to buy our bonds. They don't trust us. Inflation is here to stay. It is continuing to, be fostered by the irresponsible spending and fiscal policy of the U.S. government, who's, again, accumulating over $1 trillion in debt every 100 days. And this is a situation that won't end well, where ultimately the Federal Reserve is the only one foolish enough to buy the treasuries. And as all of these countries shed treasuries and accumulate commodities which have no counterparty risk, which are being viewed as money around the globe, and in much of it anyway, it's a safer place to be. And so, yeah, I think that this is just beginning, and the technicals are starting to bear that out. And look, through so many years of naysayers and of counterintuitive action and suppression by the central banks, I understand why most of the people in the know would blow this off and say it's a nothing burger. But, I think one of these days, when you see the accumulation accelerate, when you see the action in Shanghai accelerate 200% in the last 2 months, when you see repatriation by very prominent central banks, including 2 of them that just joined the BRICS, all of these things accelerating and put together have a greater significance. So yeah, I'm inclined to believe that we are in the midst of a bull run here. How high it goes, I don't know. Some people are talking 2,700, 2,800, maybe even the psychological barrier of 3,000. But I do think that people who are waiting for a pullback, it's too late in the game to do that. I mean, it is, maybe. I mean, it seems that way to me. So instead, the better way to do it is to cost average. And if you have an amount to spend, instead of waiting for a pullback, divide it into 4 and buy every week or every 2 weeks, or increase your purchasing if you feel you have to. But waiting for that pullback could be something that keeps people waiting for a very long time.
Andy Schectman highlights the latest trends in the precious metals market. Recent technical analysis reveals a significant breakout in a 12-year cup and handle formation, signaling a bullish forecast for precious metals, particularly as global demand spikes, with substantial shipments to the Shanghai exchange. Meanwhile, physical availability is tightening. Silver Eagles, for example, are seeing increased premiums, suggesting that silver is currently under-owned and undervalued. This shift underscores a larger global trend as countries increasingly move away from U.S. treasuries in favor of commodities like gold and oil, reflecting a growing distrust in traditional financial systems and anticipating continued inflationary pressures. Investors are advised to consider a long-term perspective, regularly investing in precious metals as a hedge against economic instability. Like, subscribe and share this video with a silver bug because more people need to start stacking. Now, let's get back into the episode.
Maybe that's why we're seeing such great strength. It's interesting, they try and knock it down, whoever they is. They try and knock it down. Maybe Bank of America, who's got this wickedly large short position of roughly 1 billion ounces of silver on COMEX and 30, 40 million ounces of gold on COMEX, according to Ted Butler. Obviously they have a vested interest in mitigating its rise, but it comes right back up. And because a lot of this, Dunnigan, has to deal with the fact that these countries, even a few years ago, were not sophisticated or wealthy enough to do this, but in concert. And I think over the last several years, not only in concert are they doing this together now, but the sophistication, the wealth, the understanding of what's happening. Yeah, they're beating us at our own game, whether it be exchange for physical, by first shorting the paper price, and it appears to be HSBC Bank, shorting the paper price and then standing for delivery on the OTC market with huge amounts of gold, and or India importing 500 million ounces of silver, which is right now, according to the COMEX registered category, is, there's only 300 million ounces in registered and eligible combined, only about 45 million ounces in registered. Those are the bars backing the contracts. India's imported more than the entire COMEX ecosystem and 11 times more than the registered category. But that doesn't count what's happening on the Shanghai exchange, and so these countries who understand what's going on have been accumulating and repatriating, and now they're slowly turning up the heat, because if they turned it up too fast, I think it creates a problem. I think if they sold their treasuries too fast and tried to arbitrage too fast, because ultimately I think that's what happens. I think ultimately at some point you will see Moscow or Dubai or Shanghai, they'll say silver is now $60 an ounce and gold's now 4,000 an ounce. And just like that, everything would arbitrage over there and the price would gravitate to it. These are the countries that produce it. These are the countries that accumulate it. And these are the countries that understand there is a pivot moving away from the dollar, with a large portion, certainly of the Southern Hemisphere, viewing gold and oil as a safer play, one that cannot be confiscated or sanctioned against them the way that it has been against several other countries, as we've documented well. So yeah, I think you will continue to see arbitrage opportunities here, because look, there aren't a lot of traders out there who have the sophistication and the ability to access these markets. So it's the commercial banks and whatnot, but who knows when they turn it up even higher. But it has been consistent with silver now for well over a couple of months, and we don't see any sign of it slowing down. Gold, that spread is a little tighter right now in my career. If you look, typically when the ETF participation falls the way that it is, typically the price would fall with it, yet it's going higher. When you look at positive real return on the treasury market, usually the price of gold would fall. It isn't. When you look at a dollar as strong as it is on the dollar index, usually the price of gold would fall. It isn't. The demand from the central banks and the big money in China and India and Russia and these countries that are doing what we just talked about is strong enough not only to put a floor under the price of gold and silver, to give it resiliency when it gets smacked down by the naked shorting of the Western commercial banks. But at the same time, we're seeing massive physical demand by the public in China, where the demand for their ETFs are triggering the breakers on the upside because the demand is so high. And we've seen really a lot of selling. In fact, it surprises me how much selling we have seen into these rallies in gold and silver by the public. The only thing that really is becoming harder to get and showing us higher premiums have been silver eagles. And maybe that's a precursor, but everything else I would say is ridiculously undervalued. He said, look, the only thing holding up the market has been central bank buying. And when the American public does wake up, we will see what real demand looks like, what real movement looks like. And the American public has really been largely asleep at the switch. And when the central banks, 2024 first quarter, the most they've ever bought ever in a first quarter, which was bigger than last year, which was the biggest. When these folks are buying the way that they are, it should tell you where this is ultimately going. They know the playbook, but yet our market here in the West is providing really amazing prices and availability and low premiums. In fact, the lowest buyback premiums I have seen in my career.
Do you agree with Andy Schectman's take? Is the breakout of this cup and handle a great buying opportunity as momentum is favoring longs? Or do you think everything will fade, trapping early longs? Share your honest opinion in the comments section down below and watch this video right here, because it's a perfect fit for you. I see you on the other side.